maybe talk a little bit about why people need to be investing differently today,
Sure.
and what the smart money kind of does in the world.
Well, we've talked a little bit about our belief that the financial services industry is broken, and I think there's a number of places that I could expand on. But one of the primary ones is how investment advisors encourage their clients to invest. So a perfect example of that, a senior executive at a very, very large insurance company that has billions and billions of dollars that they invest. So to make, and the reason the insurance company invests that money is they've got to pay insurance claims. So they're investing for the long term. They know they're going to have capital needs on a regular basis, so that capital needs to produce income. And first and foremost, don't lose the principal, right? Because if you lose the principal, you can't meet all your obligations. And believe it or not, in Canada, well, believe it or not, OSFI regulates a lot of that. So you sort of got your hands tied on. You can't be overly creative. You need to make sure that you can meet your obligations, and that is tested on a regular basis. And so I spend a lot of time in that side. So learning about where we invest, how we invest. And then you do a 180 and you talk about, okay, well, we've got salespeople out there and they're selling investment funds. And most of those would be segregated funds with insurance company or mutual funds. And guess what? Polar opposite. Like there was no similarity whatsoever on what an average client's portfolio looked like and how the insurance company invested their money. So the insurance company was investing in mortgages, real estate, private equity, and very institutional. It was that mindset. And then you'd deal with individual clients and you'd go, now just sell them this 60% stocks, 40% bonds, and hey, that's diversification. And I think that that always really was a hard thing for me to get. And it was a real opportunity when we started WealthCo to say my vision of what I'd love this firm to be able to deliver to people was everybody deserves that institutional investment philosophy. Now, I hate to say it, I'm a couple years over 40, and the older I get, the less risk I want to take, and really that's predicated that sort of risk anxiety predicated this investment philosophy to be what was the cornerstone of how we built WealthCo. Investing in stocks and bonds, like really? We've all been through turbulent times, a lot of those recently, where we've seen significant decreases in a market. And if the vast majority of your capital is invested in one thing, it doesn't really work. And the other thing that's become more and more apparent on a global basis, the world in the 1970s and 80s, when I started in the business in the 1980s, wow, seems like a long time ago, in the late 1980s, we were focused on diversification globally. So you'd have some money in the US, some money in Canada, some money in Europe, some money in Asia, and you're set, because obviously all of those markets are going to work very, very differently. Well, look at the last 20, 30 years. Every major financial event, every single one of those areas has been affected. And so global diversification, thinking you're just investing in stocks, is not diversification. So back to, how does the insurance company invest? Real estate, mortgages, private equity. I mean, all sorts of different asset classes that move in different areas.
So more tools in the toolkit, so to speak.
For sure. And a goal of flattening the growth curve. So, I think of it as I spent the early part of my career riding the investing roller coaster with my clients. And that sucks. So you're either on your way up, everything's fantastic, I love going out and talking to clients, or holy crap, we just went through this thing, now I got to go back, and peaks and valleys. And especially with business owners, the last thing you need is uncertainty. There's already enough uncertainty as a business owner. So this pension-style asset management of bringing all those different asset classes together flattens the curve. So, and that doesn't mean that you're going to earn a higher rate of return. It just means that you're going to have a lot less peaks and valleys.
Right.